Thank you for trying financetrainingcourse.com, an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals.
Welcome to our last and final session on asset liability management. In this session, we take a look at core ALM reports that help us answer a handful of basic questions. If you remember, when we first started this course, we started off with a question that dealt with how do I answer when my shareholders or board of directors or board risk committees ask two very simple questions. The first question is, based on a movement on interest rates, so this is rates, and the allocation that I have made on my balance sheet across assets and liabilities, so across assets and liabilities, what is the amount that I would lose in terms of shareholder value? Shareholder value. And what is the change in my net interest income? So my objective is to answer these two questions, and to answer these two questions there is a sequence of reports that we need to get very comfortable with. So keeping it very simple, if we go back to one of the first lessons that we covered, we spoke about the fact that there is a very simple relationship, and that simple relationship says that assets minus liabilities equals equity. And in our framework, what we're going to do is we're going to simply look at this relationship, but we would look at it at a slightly more detailed level and try and understand what happens. If you also remember, in our last session, we looked at a list of definitions and we spoke about something called duration, which we labeled as interest rate sensitivity and convexity. In the reports that we will use and that we will work with to answer question number one and question number two about shareholder value and net interest income at risk, duration will play a very important role. Even though we've defined it earlier, I would strongly recommend that you go through the associated related material available on the page of this course that talks about both duration and convexity, and make sure that you're very comfortable with this topic before you move further. Okay, so what we have in front of us is a simple template of a report, which is a basic fundamental building block of an ALM system. And in this specific case, let's call this bank A. So we are working with bank A, and bank A, there we go, this is bank A. Now bank A has an interesting profile in the sense that what we've done is we've broken down bank A's cash and liquid securities, and we've broken this down into tenors or maturities. So we're saying for bank A, here's the amount that actually matures in 3 months, here's the amount that matures in 6 months, here's the amount that matures in 1 year, that matures in up to 5 years, and up to 10 years, and greater than 10 years, right? So each of these buckets covers the amount that's in 6 months, the amount that's between 6 months, 3 months and 6 months, amount that's between 6 months and 1 year, in 1 year and 5 year, and up to 10 years, and then greater than 10 years, right? So if you look at this, we're saying, we've got about $675,000 in cash and liquid securities that will mature in 3 months. We've got about $17.9 million excuse me, in government securities that will also mature in 3 months, and about $60,000 in corporate bonds that will also mature in 3 months, for a total asset maturity of about $18.635 million. And then the same profile occurs in the 3 and 6 month window. A similar, slightly different profile occurs in the 1 year window. A very different profile occurs in the 5 year window, and a slightly smaller exposure in the 10 year window. So if you look at the asset profile of this specific institution, you can actually say that these guys are actually top heavy. Top heavy in the sense that bulk of their exposure, the 48 million here, the 35 million here, and the 53 million here, bulk of their exposure is in maturities beyond 5 years, 5 years up to 10 years, and greater than 10 years. And while they have some exposure in the first 3 years, in the first 3 buckets, which is 3 months, 6 months, and 1 year, a large part of their exposure is in the longer term tenor. Okay. Over here you can see that there is a heading that says contractual maturity, or says price sensitive gap. So what this basically means, that from a bucketing point of view, when I went through all the assets of this bank in question, I actually segregated them. I actually coupled or clustered them together in terms of the time at which the underlying asset would actually mature. So if this is the asset side, if we take a quick look on the deposit side, we're saying, on the deposit side, we have two primary sources of deposits. One is deposits is from customers of the bank, and the second is interbank borrowing, money that we borrow in the interbank market. And again, if we look at this profile, we can see that a large part of their exposure is, if you look at total liabilities, 59 million here and 35 million here, right? A large part of their exposure is in long-term assets. So if I were to walk through this bucket by bucket, what I'm really saying is that, look, up to 3 months window, I've got about 18 million in assets and I have about 13 million in liabilities, which means that I have about 5.275 million excess of assets. So if I were to look at the 3 month window again, what I'm effectively saying is, I'm saying I have 18.635 million of assets maturing in 3 months, and I have 13.36 million of liabilities maturing, leaving me with a gap of about 5.275 million. So what does this mean? What does this 5.275 million represent or reflect? What we're really saying is that at the end of 3 months, when my assets mature, I'll actually have an excess of 5.275 million available that would need to be reinvested. Same thing here. In the 6 month window, I've got 18.635 million in assets and I've got about 13.36 million liabilities, leaving me again with a gap of 5.275 million. In 1 year, the gap increases to 11.34 million. In 5 years, the gap increases to almost 41.8 million. And it's only when we come to the 10th year, we find that we actually have a negative gap. A negative gap that reflects that I have assets worth 35.92 and I have liabilities worth 59.45. Now, when we speak about this gap, what does this gap represent? And when we say what does this gap represent, there are actually two separate relationships. The first relationship is with respect to shareholder value. That's this relationship. This relationship basically says that assets minus liabilities equal equity, or if you're interested in what's the change in the value of the balance sheet, weighted average duration of assets minus the weighted average duration of liabilities has a direct relationship to the change in surplus or the change in value of the equity. If you remember case number one, first example that we looked at was a bank with 100 billion in assets, 90 billion in liabilities, 10 billion in equities. All of these assets were invested in the 10-year note. This liability was a 1-year deposit, giving them an equity of about $10 billion. When interest rate moved against the bank, all of this equity was wiped out, right? This is the same relationship. So effectively what you're saying is that if I have positive gap here and interest rates move, if they actually move higher now, not 3 months from now, if the rates moved higher, since the duration of assets is the same as the duration of liabilities, because the same bucket, from a duration point of view, we have some level of matching. That's not a problem. However, where we do have a problem is that the weighted average duration of assets, because the volume of assets is higher, versus the weighted average duration of liabilities, because the volume of liabilities is lower, is going to lead to a correction in shareholder value. And we'll see this in the reports that come a little later. That's one relationship, right? The second relationship is income. So the first is shareholder value. The second is net interest income. Now, with respect to net interest income, what's going to happen? What's going to happen is at the end of 3 months, if rates have gone up, so if the return that we can book on an asset has gone up, at the end of 3 months, we will have more assets to invest. right? Because there is a gap. And we'll have, but at the same time, because rates have gone up, the liabilities that we go out and use to fund this exposure would also be more expensive and pricier. Okay. And the same thing will repeat in the 6-month window, in the 1-year window, in the 5-year window, the 10-year window, and the up greater than 10-year window. Right? So this is one part of the balance sheet. And if you remember, we spoke about setting the context, using the context of the balance sheet for our analysis. This is what we meant. What we've basically done is we've taken Bank A, broken Bank A into categories of assets and liabilities, and then further broken it down by a given maturity bucket. So in addition to what we call interest sensitive or rate sensitive instruments, we also have something that's classified as non-price sensitive. These are assets that will not have a change in the value, will not suffer an impact or reflect an impact or witness an impact if interest rates move up or down. And then over here we have the total amount, which is about, so the bank's balance sheet is about 128 billion. You've got a breakdown of the contractual or price sensitive gap. Now there is another type of gap which is called rate reset or rate sensitive gap. And in this gap, in the previous gap, we said, anything that is maturing in 3 months, anything that's maturing in 6 months, anything that's maturing in 1 year, anything that's maturing in 5 years, anything that matures in 10 years, and so on and so forth, right? However, in rate reset gap, we're not so much interested in contractual maturity, but the time at which both the asset and the liability get repriced. So at what time, if I have a 10-year loan and this loan has a contractual reset where the rate gets reset every 6 months, it will not fall in the 10-year bucket in the rate reset gap. It will actually fall in the 6-month bucket here. In the contractual maturity or the contractual gap or the price gap or the maturity gap that we saw above, it will fall here. However, in this specific case, in the rate reset gap, it will fall in the 6-month window. So what we're saying here now is that, anything that resets in 3 months here, in 6 months here, in 1 year here, up to 5 years here, up to 10 years here, greater than 10 years here. And in essence, you've done more or less the same calculation. You've calculated total assets, but these assets have been calculated on the basis of rate resets, and you've calculated total liabilities, and you've calculated gap. Okay, so the difference between assets and liabilities, as far as we are concerned, both in terms of contractual maturities as well as in terms of rate resets, is called gap. And ALM, to a large extent, uses these gaps to determine the answer to the questions we'd asked earlier. What's the change in my market value of shareholder equity, and what's the change in my net interest income? So if you have these two reports, if you have the rate reset report and the contractual maturity gap report, what can you do with this? What you effectively do is you take the gap from each of the buckets that we've just looked at earlier. So if you go back to the previous slide here, this gap is 525, 5525, 5525, 11, 700, 4605, minus 560, minus 1350, right? If you come down, so 5525, 5525, 11.7, 460, sorry, 11.7, 460, 560, and minus 1. So this set of numbers, this original cumulative gap collection of numbers, is basically coming from the report above, the rate reset report that we saw earlier. Sorry, this is okay. So this number is actually coming from this layer, from your gap report. And what you're now doing with that gap report, the first question you want to answer is, what's the impact on income? So to assess the impact on income, in ALM, we use a report called Net Interest Income at Risk, or NII at Risk for short. And NII at Risk starts off where the rate reset report left and uses that gap and then simply shocks that gap. So what we've done is saying, if interest rates go up by 25 basis points, they go up by 50 basis points, if they go up by 1 percentage point, what is the impact on my net interest income in the 3 month, in the 6 month, in the 1 year, in the 5 year, and in the 10 year bucket, and in the greater than 10 year bucket. And the cumulative sum of these changes, this is the impact. The cumulative sum of these changes is the number that you look at when it comes to net interest income at risk. Let me just see if I can remove this. There we go. And remove this so we can see a clearer look at the number. So we're saying, given the current interest rate mismatch profile of the bank, if rates go up by 25 basis points, the impact, or if rates move rather than go up, if rates move by 25 basis points, the impact is going to be plus minus 154 for 25 basis points, plus minus 309 for 50 basis points, plus minus 1% for a full percentage point. And it's this number, if you remember in the ALM framework, we spoke about the fact that you have risk, you have exposure, and you have target account. Right? So what's the exposure? The exposure is your balance sheet gap in a given maturity bucket. That's the exposure. What's the risk? The risk is interest rate moving up or moving down. What's the target account? The target account is NII at risk. And you can decide whether when you calculate the NII number, whether this number is going to be at 0.25%, whether it's going to be at 0.5%, or whether it's going to be at 1%. That's your choice. So you've looked at 3 reports. You've looked at a contractual reset report. You've looked at a rate reset report. You've now looked at an NII at risk report. Let's do a slight variation. And in this variation, what we're now going to look at is earnings at risk. So the primary difference between earnings at risk and the NII at risk report is that, think of an NII report, the report that we just saw earlier, where we basically moved rates by a pre-given, preset interest rate shock, and then we estimated the impact of that movement on income. Here, what we're doing is we have simply replaced the assumption, replaced the 25 basis points, replaced the 50 basis points, replaced the 1 percentage point, not by an estimate, not by an assumption, but a number that comes to us from our value at risk estimate for an interest rate shock in that bucket. And then we use this to estimate what's the impact, what's the total impact, what's the cumulative impact, both for assets and for liabilities, giving us this number. So if I go back here, I go out and say there is as per my NII report, if I use an interest rate shock of 50 basis point, there is a chance that the NII number, the net interest income at risk number, is going to be plus minus 309. So I go out and say this in front of my board risk committee. And a board member looks at me and says, I understand all of the work that you've done and I appreciate what you've done, but I have a very simple question, and that simple question is this plus minus 309 to 50 that you've just calculated and shared with us, what's the probability? What's the likelihood of this event happening? Because once you give me a probability, it's only then that I can appreciate the exposure and the risk that I have in front of me. To answer this question, we move on to earnings at risk. And if I want to calculate this at 60 percentile, 75 percentile, 90 percentile, or 99 percentile, these are drivers that determine what is the range of shock that I'm likely to see. Again, as I said earlier, this is a topic that we've covered in the value at risk course, which is available as part of this exercise, so just look for the value at risk session, and there's material both in print, in online HTML form, as well as in terms of a video course that you can walk through. So take a look at the value at risk course to understand what we're doing here, where these numbers are coming from. For the time being, let's just assume that you've gone through the VAR course and we understand how to go from 60% to a range of shocks. So a range of shocks that I get at 60 percentile are very different from a range of shocks that I get at 99 percentile. A range of shock at 60% has odds that are almost equivalent to 1:2. So one day in 3 days, I will see a result like this or a shock like this and a movement like this. In a 99 percentile case, the odds are almost 1:99. 1 in 100 days will I see an odd like this, a movement like this, a shock like this, an impact like this. Okay. So what we've done so far is we've said, look, take a look at this rate, apply this rate or rate shock, figure out how the numbers change for assets, figure out how the numbers change for liabilities. Based on the gap in question, you will get a net number. This net number is very, very different. Assuming that my rate shock was determined at 99 percentile, I'm saying there is now a 1% chance that we will see a rate movement along the lines, a shock movement along the lines of what we've just projected for each of the buckets, for as well for assets as well as for liabilities. And based on that estimated rate shock, there is a 1% chance that we will see a movement which is larger than 1.036 million, right? So 1.376 million, that's the number. If you compare this with the number earlier, which was I think 309 and change, plus minus 309 and change, we now have added this probability estimate, this percentile estimate that we can use as part of our work. The last and final report that we need to look at, that we'll look at in the next session, basically looks at not earnings at risk and not income, but looks at shareholder value. And the analysis and the approach is exactly the same. You start off with your, rather than rate reset, you start off with your contractual maturity. And once again, as we said, you break the assets down, break the liabilities down, calculate the gap, calculate the net cumulative gap, and then you already have weighted average duration of assets because you have the balance sheet available, and you have weighted average duration of liabilities because again you have the liabilities available. You look at the difference, and this difference between weighted average duration of assets and weighted average duration of liabilities is the number that gives you an indication of the amount that your balance sheet number, your shareholders equity number, would move on a mark to market basis if interest rates went up by 1% or came down by 1%, just like NII at risk. So just like NII at risk, there are again two variations of this report. So we said traditionally, conventionally, we have net interest income at risk. We have earnings at risk. We have market value of equity adjustment. And we have MVE at risk. The MVE at risk is sometimes also known as the capital at risk report. And the primary difference between these reports, is that, let's just draw a simple table that will help us address and understand how this gets calculated. The primary difference between these reports is that two of them are static, two of them are dynamic, and two of them give us an associated probability as well as a target account. So if I were to work with something, NII at risk is a static, NII at risk is a static report. So this is a static report. It's not dynamic. Earnings at risk is a dynamic report. MV adjustment, just like NII at risk, is a static report because you start off with a preset, pre-given rate shock that then goes into your calculations. MV at risk is a dynamic report. And capital risk is the same thing as MV at risk, is also a dynamic report. More importantly, NII at risk will not give you a probability. but earnings at risk, MV at risk, and capital at risk report will give you probability. The MV adjustment will also not give you a probability. And finally, all five of them have the ability to give you a target account. Now, when I said all five, please note please note that what I basically meant was that these two are being used interchangeably. So this was a very quick and brief and dirty introduction to ALM reports that we use as part of our day-to-day work. Once again, the focus of this analysis, the work that we've done so far, the focus of this analysis is to answer two very simple questions. What is the impact of changes in interest rates on my shareholder value on a mark-to-market basis, one, and on my net interest income based on interest rate outlook. Historically, traditionally, conventionally, we would answer one of these questions. What is the impact on shareholder value on a mark-to-market basis by using the tool of duration. The reports, the 4 or 5 reports that we've looked at very quickly, use exactly similar approach, exactly similar framework, but do it at a much higher level of detail and analysis. And our hope is that by using this additional level of detail, we can have a better understanding of the risk exposure of the bank to interest rate changes, to funding and gap changes, as well as have a better appreciation for the ranges of value that we can use for stress testing bank capital. I hope you enjoyed yourself in this session. Thank you very much for your time. This is Jawad Ahmed Fareed signing off for financetrainingcourse.com.